Hi, my name is Bobby Casey. I am the founder of BusinessAnywhere.io. I'm an international tax lawyer. I've been working with clients all over the world for 20 plus years, helping them with company structure, tax optimization strategies, residency, asset protection planning, things like that. And we've been working with thousands and thousands of clients. So in today's video, we're going to be discussing a hot topic that we hear all the time, that you see it all the time in blog posts, in videos, on forums, on Facebook groups. And the topic we're going to be discussing is the 183-day tax rule a myth? And what actually determines whether you are a tax resident in a particular country or not? So, first of all, I want to tell you right off the bat, it is a myth. There is no such thing as a 183-day tax rule. Now, that may come as a shock to many of you watching this video because for years and years and years, I've been seeing it everywhere. Like I said, in other videos and blog posts that says, if you're in a country more than 183 days, you are by default a tax resident. That is not true. And the reason I say that is because it is so much more nuanced than just having the one thing that says if you're in the country more than 183 days, you're a tax resident. For example, some countries do not have anything about being in the country 183 days to make you a tax resident. The United States is a good example of that. There is nothing in the tax law in the US that says you become a tax resident after 183 days. Actually, they have a formulaic determination called the substantial presence test, and it is a mathematical calculation over a rolling 3-year period that determines whether you are a tax resident. It is not 183 days in any one given year. Some countries, Spain is a good example, where they do have part of the law that says if you're in the country more than 183 days, you may be a tax resident. However, you may not be a tax resident if you're a tax resident of another country that has a tax treaty with Spain. If you are a Spanish person and you own your primary home in Spain and you travel 11 months out of the year, you're actually still considered a tax resident of Spain. So there's a lot of nuances here. Actually, the only country in the world that I know of that has a 183-day tax rule, that is essentially their only rule, and trust me, I have read the tax residency report for almost every country on the planet, and the only country I've found that does have a clear 183-day tax rule is Ukraine. And it's kind of unusual, but I found it several years ago, and I was kind of surprised that was their only rule, but that is a fact. So you've got to really understand what it means to be a tax resident in the country where you're spending time. There's a lot of factors determining it. It can be, where do you have family, especially immediate family, like a spouse or dependent children? Where do you have your primary residence? Are you nomadic? Do you have a primary residence? Where is your, what they call, center of vital interest? Meaning, where does the majority of your life happen? Where do you go to the doctor? Where do you have your gym membership? Where do you have your club membership? You know, if you go to church, where do you have your church membership? These types of things can determine your center of vital interest, and a lot of countries look at these factors to determine your tax residency regardless of how many days you are in the country. Some countries have multiple tests to look at the determination of whether you are a tax resident or not. So in this video, basically what I want to get across is you need to consider your own personal situation and the country, number one, where you are originally from, because there are a handful of countries, well, there's a couple of countries where you're considered a tax resident no matter where you live. Like if you're a US citizen or you're from Eritrea, then you are based on your citizenship's based, or your taxation's based on your citizenship. There are other countries, for example, Finland is a good example where they have a 4-year tax rule that if you exit Finland, you leave the country. If you don't become a tax resident in another country, you're still a tax resident in Finland, no matter where you are in the world, for 4 more years. After the 4th year, you can stop filing and paying your taxes in Finland. The way out of that in Finland is to become a tax resident somewhere, notify the Finnish tax office you're a tax resident in that country, and then you can fully disconnect. And there are several countries like that. Finland is one, Sweden is is another one. I believe Norway is one. Australia is one of those countries. So you have to consider the country where you're from, your country of citizenship. And then you need to consider other factors like, where does your business operate? Do you work remotely? Do you have a team? Do you have an office? Do you have an office where you regularly go back to, and that's where your company predominantly operates? And do you have a home in that country? So you have to consider a lot of these factors. So if you want to get more information about this, we do have a product called our Digital Nomad Kit. Our Digital Nomad Kit is an all-inclusive package that helps you with your company registration, your registered agent address, your virtual mailbox, your bank account opening, your bookkeeping, tax filings, and also it includes one-on-one consultations to help you sort out and optimize your personal situation for tax residency. So anyway, I hope that helps. Have a great day.